In August 2015, Valeant Pharmaceuticals was worth nearly $90 billion. Its CEO had made almost $3 billion in personal wealth without inventing a single drug. Wall Street called him a genius. Hedge fund billionaires bet their reputations on him. Senators couldn't stop talking about him, but not in a good way. And somewhere, quietly, a company nobody had ever heard of was processing fake prescriptions in the background. This is the story of how one man convinced the entire financial world that he had cracked the pharmaceutical industry. He hadn't. He had just found a very elegant way to steal from it. Michael Pearson didn't come from medicine. He came from McKinsey, the most prestigious management consulting firm in the world. For 23 years, he advised the biggest pharmaceutical companies on the planet. He knew exactly how they made money. He knew exactly how they wasted it. And one day, he decided he could do it better himself. When Pearson took over Valeant in 2008, the company was worth about $2 billion. Nothing special. A mid-sized pharma company with solid drugs but no big story. Pearson had a very different plan. His idea was almost too simple to take seriously. Traditional pharmaceutical companies spend billions discovering new drugs. They build labs, hire scientists, run clinical trials for years, and most of the time the drugs fail. Pearson looked at all of that and said, why bother? Instead of discovering drugs, just buy companies that already have them. Cut all the research spending. Raise prices on the drugs you just acquired. Extract maximum profit. Then use the cash to buy more companies and do it again. It was the pharmaceutical industry treated like a private equity roll-up. Not science. Pure financial engineering. And for 7 years, it worked spectacularly. Valeant went on a buying spree. Over 100 acquisitions, including Bausch and Lomb, one of the most recognizable names in eye care. Revenues exploded from under $1 billion in 2008 to over $10 billion by 2015. The stock gained 1,800% in 5 years. 1,800%. That means $100,000 invested in 2010 was worth $1.8 million by 2015. Wall Street was not just impressed. Wall Street was in love. Bill Ackman, one of the most famous hedge fund managers in America, bought roughly 10% of the company and became its loudest public advocate. He put Valeant on stage at investor conferences. He called it the best company in the world. His fund, Pershing Square, had billions riding on this bet. The financial media treated Pearson like a prophet. Business school professors used his strategy as a model. Everyone wanted a piece of Valeant. Nobody was asking the obvious question, what happens when the drugs you bought start facing generic competition and you haven't invented anything new? Here's where it gets dark and specific. In February 2015, Valeant acquired 2 heart drugs, Isoprel and Nitropress. These are not luxury medications. They are emergency cardiac drugs used in hospitals when a patient's heart is in crisis. There is no real substitute. Hospitals cannot just shop around. The day after the acquisition closed, Valeant raised the price of Isoprel by 720%. Nitropress went up by 310%, not because the drugs changed, not because production costs went up, because they could, because they had a captive market of patients whose hearts needed those specific drugs to keep beating. This was not illegal. This is the part that should make your stomach turn. It was not illegal. But behind the pricing strategy, there was something that was. Pearson had quietly built a secret weapon, a specialty pharmacy called Philidor RX Services. On paper, Philidor was an independent company. In reality, Valeant controlled it, had an option to buy it outright, and used it to route expensive branded prescriptions through insurance in ways that a normal pharmacy never could or would. Philidor would override requests for cheaper generic alternatives, push the pricier Valeant versions, and help the company collect insurance money it might otherwise not have seen. The most important detail, none of this was disclosed to investors, not in earnings calls, not in filings, not anywhere that the people betting billions on this company could actually find it. Meanwhile, the financial reports looked extraordinary because Valeant had invented its own way to measure its own success. Instead of reporting standard earnings, the company pushed a metric it called cash earnings per share. This number excluded the enormous costs of all those acquisitions. the depreciation, the amortization, the very expenses that any honest accountant would say belong in the profit calculation. Strip those out and the company looked like a money machine. Include them and the picture was far less flattering. The debt was over $30 billion. The entire empire rested on cheap, borrowed money, continuous acquisitions, and the political tolerance for unlimited drug price increases. All three of those things were about to run out at the same time. By mid-2015, the cracks were already there for anyone willing to look. United States senators were sending letters demanding explanations for the price hikes. Doctors were publicly saying hospitals couldn't afford the cardiac drugs. Bernie Sanders had Valeant's name in his mouth at campaign rallies. For a company whose entire business model depended on raising prices freely in a market without political pushback, this was not noise, this was a category-level threat. Then the short sellers arrived. Short sellers are professional skeptics. They make money by finding companies whose stocks are overvalued and betting against them. A firm called Citron Research had been studying Valeant for months. In October 2015, they published a report calling Valeant the Pharmaceutical Enron. They had found the Philidor connection. They had followed the prescriptions. They had traced the accounting. The stock dropped 15% in a single day. Valeant came out swinging. Management called the report misleading. Ackman defended the company publicly with prepared presentations. For a moment, it looked like the story might die. It didn't. Within weeks of the Citron report, Valeant quietly announced it was cutting all ties with Philidor. That decision, meant to contain the damage, confirmed everything the short sellers had been saying. Why would you cut ties with an independent pharmacy if it wasn't actually yours? The Securities and Exchange Commission opened a formal investigation. The Department of Justice issued subpoenas. The stock, which had traded at over $260 per share in August 2015, fell below $30 within 18 months, 90% gone. Pearson was removed as CEO in April 2016. He and Ackman sat before the United States Senate and apologized, not to investors, to patients. In the year 2020, 5 years after the Philidor scheme began unraveling, the company, by then renamed Bausch Health, paid $45 million to settle Securities and Exchange Commission charges of improper revenue recognition. No prison time for Pearson, no personal criminal conviction. And Bill Ackman, the billionaire who had championed this company louder than anyone, exited with losses estimated between $4 and $5 billion, one of the largest single investment losses in hedge fund history. A man worth billions, humbled by a company that built its fortune on drugs patients couldn't afford to stop buying. Here is what you should carry out of this story. When a company stops reporting standard earnings and invents its own metric to measure success, pay attention. Valeant's cash earnings per share was designed to make the debt invisible and the profits look clean. Whenever a company tells you to ignore the standard numbers and trust their special version instead, ask why. The answer is almost always hiding something expensive. Watch the debt. Valeant had $30 billion in debt funding a growth strategy that needed everything to go right simultaneously. Cheap rates, continuous acquisitions, and zero regulatory interference. One disruption collapses the whole structure. Before investing in any company growing fast through acquisitions, ask one question: what does the organic growth look like without the deals? If the answer is flat, the growth is borrowed. Political scrutiny is not theater. When senators start holding hearings about a company's core business model, that is a risk that does not appear on any balance sheet until it does. Regulatory exposure in a politically sensitive industry like healthcare or finance is a real, quantifiable threat. Ackman dismissed it. It cost him $5 billion. And the final lesson, the one that applies whether you are an investor or building a business of your own. A model built on extraction always has an expiration date. Valeant didn't build anything. It bought things, raised prices, and called it strategy. There is no moat in that. There is only a clock. The next fraud is already being built on a spreadsheet somewhere, with its own custom metrics, its own undisclosed relationships, and its own conference room full of people who believe the clock will never run out. Subscribe to Capital Sins so you see it before the collapse. Every week we pull back the curtain on another billion-dollar implosion and show you exactly what to look for. If this one made you think twice about the next genius strategy on Wall Street, hit like. It helps more people see the warning signs before it's too late.